Genuine Parts Company is a dividend king trading at a PE of only 13.9, which is a 22% discount based on their 5-year average PE of 17.8, but the current PE ratio doesn't tell their whole story. GPC sells automotive and industrial replacement parts through multiple brands including Napa in the US, Motion Industries in North America and Australasia, UAP in Canada, the Alliance Automotive Group in Europe, and lastly, GPC in Australasia. Their parts are used in automobiles and all types of industrial equipment including electrical equipment, hydraulics, and pneumatics, to name just a few, but hundreds of thousands of industrial and automotive parts are replaceable through GPC. GPC advertises itself as a global company, which is true, but by revenue they generate 66% of their sales from the United States and 34% abroad, with 16% coming from Europe, 9% from Canada, 9% from Australasia, and less than 1% from Mexico. So they are fairly well diversified geographically, and better yet, each geographical segment has grown in sales year over year since 2021 to their most recent annual report in 2023. By business segment, their largest group by revenue is automotive, coming in at 62%, leaving 38% of revenue coming from the industrial segment. Although in terms of net income, their industrial segment is more profitable than their automotive segment, proportionally to revenue, with 52% of profit coming from their automotive segment and 48% of profit coming from their industrial segment, which indicates to me that they have more of a competitive advantage in the industrial space than the automotive space, which makes sense because there are so many automotive parts producers and probably far fewer industrial parts producers. Now let's cover the macro level pros of GPC's business. The first subtle pro that I came across when looking at their 10K is that 80% of their automotive sales come from a group called Do-It-For-Me customers, or DIFM, compared to 20% of automotive sales from Do-It-Yourself customers. I imagine that the Do-It-For-Me customer is more robust than the Do-It-Yourself customer because the DIFM customer will come into a shop with little automotive expertise and simply adhere to most recommended services and parts that a repair shop recommends, versus a DIY customer may be more savvy in knowing which parts truly need to be replaced at any given time. I also would assume that the Do-It-For-Me customer has more expendable income than the DIY customer, which is a benefit to GPC. Regardless of how GPC differentiates their customers, they generally sell essential parts for vehicles, which people rely on to get to work and to live their lives. If a car part needs replacing, I think most people would prioritize the part and service to maintain their ability to drive. And even if someone couldn't afford a car service, they would probably justify using a credit card to keep using their vehicle. Another pro to GPC's business is that they are fairly well diversified by geography, business segment, and product type. And in their automotive segment, under the Napa brand alone, they sell more than 800,000 parts. GPC seems to provide some essential parts across the globe, but there are some risks to consider. The first being that they provide industrial parts, which makes up 48% of their net income, and the industrial sector as a whole is cyclical. This cyclicality can be seen through various metrics, but a potentially leading indicator for the industrial sector can be seen through the RLB Crane Index, which surveys the number of cranes in operation in key cities in North America across various sub-industries. As of Q1 of 2024, the number of cranes in operation decreased by 18% compared to the same time last year, which indicates that the industrial sector is slowing fairly rapidly, which translates to a decrease in industrial equipment being used to facilitate those industrial projects, and less parts being replaced for GPC. Or if we look at GPC's latest quarterly report, they state that the industrial sector, as measured by the Purchasing Managers Index, or PMI Index, is in its longest period of contraction in over 33 years, which they state as the cause of their recent quarterly earnings decline of 24%, as compared to the previous year's quarter, which we'll cover later in this video. This is all to say that the US and the global economy may be headed into a recession, which could negatively impact GPC's revenue and net income. Not to mention, if we were in a recession, despite car and industrial parts being essential, people may defer purchasing parts even if they should replace them. Now let's get into the foundation of the business, starting with revenue. Here on the right, we see GPC's revenue has been quite consistent over the decade and only had a minor downturn in 2020, indicating to me that their products seem to be essential and that they have a stable customer base. Since 2020, they've also had a respectable growth streak, which was preceded by a few years of essentially flat or slow revenue growth, giving them a modest 10-year compound annual growth rate of 4.2%. Their earnings per share on the left again shows stability, but with more growth than revenue, coming in at a 10-year CAGR of 7.3%. But their trailing 12 months net income is declining, and if we look more granularly at their earnings by quarter, their earnings have declined by a massive 24% compared to the last quarter, which is likely the cause of their recent crash in price, along with their guidance also predicting a further decline in earnings than previously projected, which initially was expected to be in a range between $9.30 to $9.50 to a current prediction between $8 to $8.20 per share for the year. Or if we look at free cash flow on the right instead of earnings, their growth rate is substantially slower than EPS and actually slightly slower than their revenue growth at a CAGR of 4.0%. On the left, we have their shares outstanding, which are declining, which is always a positive since your shares are increasing in value even if share price doesn't, which also reduces the total dividend load for GPC. Although they've only reduced their shares by a CAGR of 0.88% over the decade. In terms of their balance sheet, they have a total liabilities level of $15.5 billion. As of their most recent report. And if we add back their cash and short-term investments of $1.1 billion, they would have slightly less debt at $14.5 billion, which I then compared to net income to determine how many years of net income it would take to pay off that debt, assuming no growth in net income, which gives us a true total liabilities to net income of 13.3 times, which is extremely high, and worse yet, they have been accruing debt at a rapid rate since 2014, going from just $4.9 billion to the current level of $15.5 billion, more than triple where they started. Although, if we just looked at their debt according to Simply Safe dividends, through their ability to cover their interest payments alone, they have a solid interest coverage level of 20.2. Now we see their current dividend yield at 3.5% compared to their 5-year average dividend yield, which is 2.7%, a difference of 28%, indicating some value to be had in terms of dividend yield. Although in comparison to their 10-year average dividend yield, their current yield looks to be only slightly above average. But current yield isn't all that matters when investing for dividends. Growth is valuable too. Here we see their 3-year dividend CAGR is at 6.9%. Their 5-year CAGR is at 5.6%, and their 10-year CAGR is slightly higher at 5.7%. If we extrapolate this data and assume you bought the stock today with a yield of 3.5% and assumed their 10-year growth CAGR would continue, you would have a dividend yield on cost of 6.1% in 10 years. But how safe is the dividend based on the EPS payout ratio? Well, over the decade, their payout ratio is quite low at 51% and hit a 10-year high of only 60%, while their TTM payout ratio is better still at 45%. Their payout ratio based on free cash flow tells a similar story with a 10-year average of 54%. Their TTM payout ratio is slightly higher at 61%. And over the next 12 months, their payout ratio is set to balloon to 229%. So depending on how accurate these predictions are, their dividend could be cut. Although if we considered only historical payout ratio data, their dividend looks to be safe, assuming their earnings remain fairly stable and they don't start prioritizing paying down their debt. Or if you like to assume dividend stability based on dividend history, they have a phenomenal dividend growth streak of 67 years, giving them their status as a dividend king, which is a longer growth streak than one of the dividend goats, Coca-Cola, with a dividend streak of 61 years. Now that we've got a picture of GPC's fundamentals, it's important to consider the price you pay. Here we see the forward PE ratio is only 13.9, which incorporates their projected earnings slowdown. And the only time during this 5-year period when it was lower was during the crash of 2020. But GPC is projecting earnings to slow, and who knows how low they may go. Or if we compare GPC's forward PE of 13.9 to the industrial sector ETF XLI at a forward PE of 23.5, GPC is trading at a discount of 41%, which is massive. Although this industrial sector ETF isn't an equivalent comparison, but gives reference nonetheless. In summary of the fundamental analysis, I think GPC is well suited for a long-term dividend growth investor, or value investor who has faith that GPC will persevere through these economic times. But one of my main concerns is that they have an extremely high debt level in conjunction with the industrial sector slowing. Here we see GPC over a 5-year period with a far below average price return of only 8.5%, but that doesn't give credit to the low price they're trading at currently. The average price for this period is shown by the center yellow standard deviation channel line, which is currently at 166, while the current price is 32% below average at 113.61. indicating an objectively low price. The price also looks to have respected the lower standard deviation channel line, which it recently bounced off of. Better yet, the relative strength index graphed at the bottom of the frame is also low, being at the bottom of the channel. And each time over this period when the RSI was this low, it resulted in a significant reversal in price. In terms of support and resistance, the price is above the next support level I see around $107, or a potentially stronger support level is lower yet at 103, although price looks to have found support with the standard deviation channel instead of based on a historic price level. Lastly, the price is far below both the 90 and 50 EMA lines, graphed in purple and blue, again indicating a below average price. So technically, GPC looks to be at a very low risk buying point based on all the metrics I consider. Let me know in the comments if you think I missed any important details, or if there's a stock you'd like me to cover. Or if you're interested in stocks trading at a low PE ratio with consistent dividend track records, check out this video covering Chevron. Thank you for watching.
I'm not a financial advisor, and this is not financial advice. This is for educational and entertainment purposes.